Over the last few days, we've been focusing a lot on what's happening over here, but it's important to remember that things that happen in other countries will inevitably affect US too. In this video, we'll be focusing on the European markets and how they are handling the crisis. We'll also talk about what China's recent economic moves could mean in light of the crisis. So stay with US and don't forget to like and subscribe. If you haven't already, it is very unusual to see Europe in the spotlight when it comes to its skills to cope with the crisis. Most of its countries tend to keep things out of the sight of the mass media in a way that is very different from the way things are managed here. In that sense, when breaking news about what is going on in Europe emerges, it's because the pressure is certainly on to start. We have the European Central Bank, or ECB. There have been many undercover talks on the market that they will do a global combination with the Fed, BOE, RBA, and RBNZ among others, which all signal that we continue to falter and more ease can be injected into the markets, especially in places where a second wave of the virus is undeniably happening and a hard Brexit is disturbingly near. Sounds like it should be the right place to start. Or at least this is the outcome. The markets will perceive if we keep seeing their economic forecasts revised upwards without the seriousness that the situation requires. They will consider that the ECB lacks activity and shows limited responsiveness to what's been happening in a number of other countries. We are aware that the ECB is following a different narrative, and we need more time to adapt to it. The story will change accordingly, but as of now, it seems they are only following rumors. Subsequently, the president of the ECB, who is always trying to appease markets, will attempt to assure them that they are optimistic enough, but not so optimistic that something drastic would have to change. A second concern is that the EU is trying to figure out what to do with Brexit, while the UK, on its own admission, is trying to act like a rogue state and break international law, as seen in recent developments regarding robo-banks. A couple of days ago, there was a meeting between the two parties, and the outcomes of this are yet to be seen. Meanwhile, the EU has been dealing with China in its latest report ever since. He says that Vestager will be meeting with Liu to talk about the EC's response to new data security laws. The China Morning Post also reports on an invite from Europe, which could see the country joining forces in its proposed new China network on data security with the chance to trade off privacy concerns. He's arguing that this would put Europe at a disadvantage for the following reasons. It would be trying to go its own way again. It would remain caught in the middle, and Europe doesn't rely on US funding or influence. The US isn't a part of NATO or the Eurozone either. The understudy, in addition to being world-beating at maths, is also something of a prodigy in another sphere. For example, he reckoned China's strategic commodities reserves could ease anxiety over energy and food security. The plan is expected to start in 2021 and is being designed to include major purchases of crude, strategic materials, and farm goods. According to local officials, the goal is to keep China safe from any disruptions. China's food supply chain has been affected by a year of racking disasters like floods, droughts, and pest infestations. As we threaten the locals with food shortages in a number of cities, our previous video covered it. We will leave the links here for you to check that one out if you missed it. This move would help avoid further deterioration in US-China trade relations, which would be a positive thing for US. This change in internal circulation could also ensure our self-reliance, which has been highly encouraged by plans to happen in the next 5 years. The Minfan report showed that the plan was related to a slower commodity expansion. It noted that industrial data showed that the Chinese bulk commodity market reported a more narrow expansion in August compared with July. China's bulk commodity inventory growth slowed to 102.5 in August from 104.8 in July, according to the Chinese Federation of Logistics and Purchasing. Even though the index for bulk commodity sales was in expansion territory, it still remained close to its counterpart for sales of industrial commodities. This shows that the supply pressure has been reduced and demand for commodities is starting to increase, which is showing positive changes domestically. The price of Brent crude oil has been on the rise over the last few days. Similarly, prices for metals and agricultural shares have also risen slightly. The Shanghai trade showed a rise in the price of Brent crude oil contracts last Thursday. According to yesterday's newspaper article, tungsten company share prices have been on the rise as of late. Although metal prices are rising because of increased demand, we remain optimistic about future growth at tungsten. The Reserve Administration has seen an increase in pork sales to help alleviate the shortage. As per two of the officials, China has already started to prepare for the plan to build the storage capacity that will be necessary for this storage program. The process will involve quickening the construction of these facilities, particularly in remote inland regions. It is being reported that the Chinese government is aiming for 90 days worth of oil, but this could increase to 180 days if commercial reserves are included. Those following up on current Chinese developments could have seen the slowdown in imports as China has been speeding up its own production and buying raw materials and strategic goods from overseas, which consequently means that the economy has slowed down. Even though FX reserves are still down on the back of a weak trade balance, this commodity boom has been pretty significant. The answer to your question is that it's related to the huge purchase by some investors of what they perceive as an undervalued currency. There's also an underlying questioning of why these stockpiles are being created. For example, what are the real reasons for China's surplus, and not the explanations we've been given? Countries have historically always been willing to trade with China, which might help explain the country's ingenuousness in its relationship with global economies. It's not a secret that foreign countries want to sell more than just raw materials. They also want to export things like technologies and commodities. China, for one, is predicting an upcoming disruption and is now trying to prepare for this moment by buying up all the oil it can lay its hands on. Many countries are currently divesting out of the US dollar in fear of a future economic crisis. The timing for this decision is rather suspicious, as we can only speculate about the motive behind it. I'm not sure any of them are completely correct. The strategy may not be specific enough, because it couldn't only refer to US action in China's trade war with the US. It makes sense that such purchases will still be made using dollars, but it's not certain, and it may be preferable to speed up the transition. That's something to keep in mind for traders of commodity futures, and it could set up a multi-year bull run and then a very sharp downturn. That is to say, in theory, after stockpiling commodities for an extensive amount of time, China would never have to worry about not having enough of a certain type of good because it could stop buying from the industry or countries that want to charge too much. If prices were too high for 1 to 2 years and drop, what's your take on China and its maneuvers? What do you think China's next move will be? Share your thoughts in the comments below. If you enjoyed today's video and would like to see similar videos, click on this video to the right. Or maybe this video to the left might be more interesting to you. I hope to see you all in the next video. Take care and remember, stay informed, stay prepared. Take care.